Here's a shocking revelation. Wholesale prices took an unexpected dip of 0.1% in August, just as the Federal Reserve is poised to make a critical decision on interest rates. But here's where it gets controversial. Could this be the green light the Fed needs to finally cut rates, or is there more to the story than meets the eye? Let's dive in. Imagine strolling through a supermarket in Monterey Park, California, in September 2025. Year over year, the headline PPI still managed a 2.6% gain, but the monthly decline is raising eyebrows. And this is the part most people miss. Asterisk, the core PPI, which excludes the volatile food and energy sectors, also fell by 0.1%, contrary to expectations of a 0.3% climb. When you strip out food, energy, and trade, the PPI still managed a 0.3% gain, up 2.8% from the previous year. This mixed bag of data has sent stock market futures climbing, while Treasury yields took a slight hit. But why does this matter? Because it's all happening just a week before the Federal Open Market Committee, FOMC, meets to decide on interest rates. Futures markets are, interestingly, the odds of a larger half percentage point cut have ticked up to about 10% after the PPI release, according to the CME Group's FedWatch tool. But here's the kicker. Is this enough to convince the Fed, or will they hold off due to lingering concerns? Services prices, a key metric for the Fed when assessing monetary policy, dropped by 0.2%, driven largely by a 1.7% slide in trade services. Machinery and vehicle wholesaling margins took a particularly hard hit, tumbling 3.9%. On the flip side, goods prices inched up by 0.1%, with core prices rising 0.3%. Food costs for final demand ticked up 0.1%, while energy prices fell by 0.4%. Chris Rupke, chief economist at Food Bonds, summed up, inflation remains above the Fed's 2% target, but officials are confident that easing housing and wage pressures will gradually bring prices down. The Fed has held off on rate cuts this year, closely monitoring the impact of President Donald Trump's aggressive tariffs on U.S. imports. Historically, tariffs haven't been a lasting driver of inflation, but the broad scope of Trump's actions has raised concerns that this time could be different. Take tobacco products, for example, which are heavily affected by tariffs. Prices jump at 2.3%. Meanwhile, the Fed's focus has shifted from inflation fears to concerns about the employment landscape. A BLS report released Tuesday revealed that the economy created nearly 1 million fewer jobs than initially reported in the year leading up to March 2025. This has sparked worries about the labor market's health, even as Fed officials continue to describe it as solid. Next week's Fed meeting will be a doubleheader, a rate decision, and an update on the economic outlook. So, here's the question for you. Do you think the Fed should cut rates now, or should they wait for more data? Let us know in the comments. We'd love to hear your take.